Hello and welcome to the MoneyMagpie Invest podcast. I'm Jasmine Birtles, founder of MoneyMagpie.com, and today we're going to be talking about tariffs. But before we do, just want to tell you that it's important that you follow us, you like us, and you comment. Do comment because I actually do look at the comments and incredibly I reply. So do that. It helps us, it supports us, and it keeps us bringing you really good ideas and thoughts from mavericks in the financial world. And today's maverick, international man of mystery, my friend Tim Price is here. Tim is one of the co-founders of Price Value Partners, which is a boutique wealth management company. And he used to be a bond trader or a bond analyst, or Mr. Bond anyway. So Tim, hello and good welcome to the Money Magpie Invest podcast.
Hello, and thanks for having me.
Now, firstly, Tim, we need to understand about these tariffs. People keep explaining them not very well, to be honest. And you have a background in bonds. So could you explain what it is that the tariffs are supposed to be doing to the bond market and why?
Sure. So the theory goes, well, firstly, what is a tariff? A tariff is quite straightforwardly a tax on goods, a tax on goods that are being exported to a country, in this case, the States. So what the Trump administration is trying to do is effectively give domestic producers of manufactured goods an advantage relative to exporters, the likes of China and India and so on. So they unilaterally make imports into the US more expensive. And it's then up to foreign countries to decide whether they then want to do tit for tat retaliation and put their own tariffs on US goods into their countries, which of course doesn't really benefit anybody, but time will tell. The reason why tariffs are such a bogeyman is that in the 19, so a quick history lesson. So in 1929, as everybody knows, we had the Wall Street crash. And the Dow Jones Industrial Average lost over the subsequent 3 years 89% of its value. So it was probably the single worst US equity market sell-off in history. And what exacerbated the problem was that two senators, Smoot and Hawley, introduced in 1930 the Smoot-Hawley tariffs, which were basically the precursor to what Trump's now doing again. So they levied tariffs on goods again coming into the US, and that ignited a trade war across the world. And I'm not an economist, but economists, I think, would tend to agree that the Smoot-Hawley tariffs of the 1930s basically accentuated, made the Great Depression worse. And that was a decade-long deflationary depression that ultimately ended in the Second World War. So there are all kinds of reasons why people are legitimately quite concerned that you have a kind of maverick president and a maverick administration that is basically tearing up the rule book and sort of going its own sweet way. And as we've seen in the last just few trading days, that's led to complete chaos in stock markets, complete chaos in basically everything, stocks, bonds, currencies, you name it.
But although, I mean, clearly tariffs are helpful to, you would think, helpful to the home producers. Isn't there an idea that the real reason why this is being done is to reduce the debt burden of the USA, which is currently huge, and that's the mechanism for tariffs and what's going to happen because of tariffs will actually bring things down. Isn't that the case? And if so, how? How does that work?
Yeah, so it's no secret that Scott Bessent at the Treasury, the new Treasury Secretary, and the broader Trump team want to get interest rates down. And as you've said, the prime reason they want to do that is because the US national debt now stands at $37 trillion with a T, so an unfathomably large number. And this year, 9 trillion of that has to be basically refinanced, most of which is coming due in the next 3 months. So it's quite front-ended. So simply to operate on a more stable fiscal playing field, it helps the US government if interest rates can go lower, i.e. yields in the bond market essentially can go lower because it reduces their funding costs. So it simply makes it cheaper for the US to borrow. So that's probably the theory behind the tariffs. And the logic is if you create chaos and notably, for example, smash the stock market, then equity investors will not stay in stocks. They'll migrate to the perceived safe haven of US Treasury bonds, US bonds issued by the US government. So that's the logic behind the tariff chaos, I think. And the problem that's now arisen, and we're only a week into this mess, is that having initially traded a little lower, US bond yields are now higher than they were when the tariffs were announced. So, in other words, whatever brief flight to safety there was in the bond market, it's already been reversed. So it's already been cancelled out by moves in the opposite direction. And if the question there is who's selling the treasuries, quite possibly it's not US domestic investors, the same way that we'd be having UK institutional investors and pension funds buying UK government bonds or gilts. It's it's more likely that the sellers of those US government bonds are actually international investors who no longer want to have anything to do with the US as a, if you like, a credit risk. And there is a quite ominous precedent on this topic because this chaos didn't start with tariffs. This chaos realistically started when soon after Russia invaded Ukraine. And what then happened was that, egged on by the then Biden administration and the US, the West levied sanctions on Russia and they froze Russia's foreign reserves, which will have included things like US dollars and US Treasury bonds. And the problem with that, and it may have seemed like a good idea at the time it was done, but the problem with that is, see that discussion we were having earlier about that 36, $37 trillion of debt. The only reason the US can sustain that amount of debt is if foreign governments, foreign investors help to fund it by buying it. So if you then basically start picking a fight with a nuclear superpower and say we're gonna take your, basically steal your money, for want of a better way of phrasing it, then that at a stroke means that all unaligned countries to the States, and nowadays that's every country, because everybody's now having second thoughts and scratching their head about how much they want to work with the likes of Trump. Every unaligned country will rethink whether it wants to own US Treasury bonds and park their foreign reserves in US assets, US Treasuries, and the dollar, or whether they'll actually prefer a more low risk alternative. And that low risk alternative is things like gold.
So are we seeing a flight to gold then? Because
Well, we've seen a very short-term correction in the gold price, but not very dramatic. So the gold price even now is still above $3,000 US dollars an ounce. Silver's come off a little bit more sharply, but gold has been pretty resilient. And whenever you get a big market shock like we've just had, and this was exactly the same case in 2008 during the global financial crisis, because gold is so liquid and there's always a market for it, there's always a bid for it, someone's always willing to pay a price to own it. Gold tends to be treated like an ATM machine during times of chaotic market turbulence. That is to say, people who are basically facing margin calls and losing money hand over fist in other areas will sell their gold, not because they want to, but because it's so liquid, there's a ready price for it. They can cash in their gold and use that to pay down losses incurred elsewhere. So that's probably what's happening in the gold market right now.
so do you think that if we give it some time, that Trump's plan could work, or do you think it's basically doomed?
It's impossible to say. We've never, I mean, I don't think anybody alive has seen this level of, of chaos in markets. And to be fair, it hasn't come as a complete surprise because he's been making announcements about tariffs for some time. So this hasn't come out of a clear blue sky. We also know that particularly the US technology market, the tech sector in the US equity market was very overvalued. So it's not a surprise that a lot of things are now sort of coming off the boil. But I don't think anyone's seen this level of basically uncertainty and chaos since probably 2008, if not since before then. So nobody really knows exactly how this will play out.
Isn't there the possibility, though, that these tariffs could be changed? I mean, nothing is set in stone. So,
Absolutely. And clearly we're seeing a lot of to and fro and sort of suggestions that the Trump administration may be backtracking, may be open to negotiation. So this is a very fluid environment, very dynamic environment. So like you say, anything could happen. It's just that Trump seems to be the kind of person that doesn't back down easily. So the fear at the moment is that this is sort of set in stone and it's for the rest of the world to decide how much it wants to fall into line. but nobody literally knows. It's that unclear right now.
So we could find ourselves actually it's at some point with the bond market going down in the way that it's supposed to, or it could stay up and cause even more problems for the American debt situation, in which
Yeah,
case,
so bond yields move inversely to bond prices. So the prices in themselves in bonds don't mean an awful lot. It's really the yield that everyone focuses on. So the yield, for example, which is sort of the current interest rate on, let's say, a 10-year bond, that'll have an impact on, say, your mortgage rate. So mortgage rates are priced via the bond market. Bank interest rates are priced off the bond market as well. So they are a key economic driver, a key input into sort of people's economic decisions. And the higher interest rates go, the more problematic that is for basically a heavily indebted country like the US or the UK. So they want to get yields down, but at the moment they're not going down, they're going up, and that's a problem.
because when yields go down, interest rates go down essentially.
Exactly. So the ideal solution for the US, for the government of the US, is that yields go down. The Fed, in turn, the US Federal Reserve, cuts interest rates and sparks more economic activity. Credit becomes cheaper. You have a sort of more like boom type conditions. But at the moment, everything's going in the opposite direction. So it looks like a disaster. It feels a bit like a disaster. So you've seen very whippy markets, equity markets across the world. It's not limited to the US. Equity markets around the world are volatile. Bonds are volatile. Currencies are moving quickly. So everything's being affected by this because we've never seen this kind of sudden shock to the system before, not since at least the early 70s.
So, what does it mean for investors, particularly those who are investing in the stock market and indeed those who are investing in bonds? I mean, I assume, for our audience, mostly UK, we're talking gilts, we're talking UK bonds, but many
Yeah.
are investing in US bonds as well, in treasuries.
I mean, the thing that any investment person will say is, an investment portfolio, particularly a pension, is an investment for the long run. So you shouldn't allow yourself to be spooked out of positions just because the market is going against you. A pension fund, I mean, for anybody, a pension fund should be something that's probably got a minimum 5-year time horizon. So whatever happens in the short run, it's uncomfortable, but you try and live through that. That said, if you're finding it difficult to sleep at night with your portfolio, then probably you should do something to try and remedy that. Now, we ourselves as a firm don't like prospects for bonds because and this is maybe at the heart of the problem for Trump, the size of the debt burden in the US is now impossibly large. It's impossible to solve. We're in the same boat. We're just a smaller economy, but we have debt of the same kind of magnitude relative to the size of our economy. So, the problem with the way the financial industry works is that people tend to treat government bonds as risk-free assets, as safe assets. We now know from the experience of the Liz Truss administration and now Rachel from accounts that the government bonds aren't as risk-free as we thought. So that may cause people to rethink the asset allocation they've got within their investment portfolios. We use other types of investments, not bonds, to try and get sort of insurance for our clients. But the more volatile markets are likely to be equity markets, particularly those that were very richly priced going into this crisis. So that seems like US technology companies. But as long as you're in broadly sensible investments, the answer is probably just try not to panic because the worst decisions are made in an environment of stress.
Yeah, true. And you've mentioned gold. So the idea, I'm assuming, is that, as interest rates go down, if they do, if it works, interest rates will go down, and as you say, there'll be lots of activity. Would that mean that gold and the other sort of safe havens would not do so well, or and
No, not necessarily. So one of the arguments in favor of gold in a declining interest rate environment is that, I mean, gold doesn't pay any income. If you own a block of gold bullion, it's just an inert mass. It's worth something, but it doesn't pay you an income. But if the interest rates are coming down, the cost of that lack of income is reduced because the income you're getting from cash or bonds is also going down. So it makes gold look relatively more attractive. Now, what really matters is the environment in which rates do move. If interest rates are going down because the Fed or any other central bank is panicking and cutting rates because it feels like it has to, that could have an inordinate positive impact on gold because people in the market will then think, my God, they've really lost control now. And then there'll be a big rush for safety. So if you remember 2008, one of the problems with that environment was that people distrusted having money in the banks. People weren't just worried about holding bank shares; they were worried about holding money in the bank as cash deposits, and that problem could easily recur because we operate in a fractional reserve banking system. So banks are never as safe as you think they are, which is why we have the compensation scheme guarantees by the FCA.
So what are you doing with your fund, with the investment that Price Value Partners is doing? Have you been moving money around, or have you just been sitting tight in the last?
We've been relatively sitting tight, so we may have tweaked some things on the margin. So within the fund that we use and within private client accounts that we manage on a bespoke basis, we don't, as I've said, we don't use bonds. We use a type of trading vehicle known as the trend following fund. And the trend following funds are useful because they can go short as well as long any market. So in other words, when markets are falling, these kind of funds can cheerfully sell into that weakness with a view of buying back later when the market's hopefully bottomed. So in 2008, pretty much every trend following fund made money because they were quite happy to short the market. And that if we're in a kind of '08 type environment, then we'd expect trend following funds to make money even when markets decline. Bonds don't offer the same type of response to market falls, so we prefer trend followers to bonds. But in terms of the bulk of client portfolios and the fund that we manage, we're not really doing anything. We've got positions in bullion, we've got positions in gold and silver, we've got positions in gold and silver mining companies and commodity companies more generally, and then what we consider value stocks more generally. You know, volatility is part and parcel of those markets, so it just comes with the territory. So we think that the world we're worried about, which is a world in which inflation gets out of control, possibly in response to the central banks overreacting to this precisely this kind of crisis. That's an environment that's very favorable for real assets, things like commodities, precious metals, relative to paper assets like cash and bonds. So we're not really realistic. We're not really doing anything, not really changing anything right now. We're quite happy to sort of weather the storm.
Great. And is there anything that you'd like to say finally to investors to give them hope, or at least some advice?
Well, being more cynical, I'd say, if you're going to panic, panic early. So it may already be a bit too late for that. But on a more positive note, some of the wisest investment advice per se ever given is 4 words: this too shall pass.
Very wise. Thank you. Thank you very much. Tim Price from Price Value Partners. This has been the Money Magpie Invest podcast. Like, share, tell all your friends, and do comment because we're very interested to hear what you have to say about this situation. See you next week.